Welcome to the channel. Here, we provide clear, actionable insights into the complex world of tax and accounting to help your business thrive.
Today, we're going to talk about one of the most powerful, yet kinda secret, wealth-building tools for founders. Seriously, it's a strategy hidden right in the US tax code that could literally be worth millions. So, let me just ask you this. Imagine, you've spent years, maybe a decade, pouring your heart and soul into your company. You finally get that huge exit. Now, what if I told you that you could walk away from that sale without paying a single dollar in federal taxes on your gains? Sounds too good to be true, right? Well, it's not. And no, this isn't some fantasy number. We are talking about a potential tax exemption of up to $10 million. It's all possible because of something called Qualified Small Business Stock, or QSBS. And trust me, understanding how this works could completely change your financial future. So, what's the deal here? Well, QSBS is basically this powerful incentive the government created to get people to invest in and stick with American small businesses for the long haul. And the reward for being patient? An absolutely incredible tax break. Okay, so let's get into the details. But I want you to think of this $10 million benefit like a locked treasure chest. To open it, you need a very, very specific set of keys. There are these super strict rules for you, the investor, and for the company itself. If you get even one thing wrong, that chest stays locked for good. Now, what's really interesting here are these first three rules, and they are all about you. First off, you've got to be an individual investor. This isn't for a big corporation buying into another company. Second, you have to get your shares directly from the source, from the company itself. And third, they can't just be a gift. You need to have actually paid for them, either with cash or your own hard work. The company also has its own tests to pass. And for this one, timing is absolutely everything. At the exact moment you get your stock, the company has to have less than $50 million in gross assets. I mean, if the company is worth $50 million and $1 on that day, your stock is disqualified. Just like that, forever. And this next hurdle, honestly, this is the one that trips up so many founders. You see, not every type of business gets a golden ticket. The government has some very specific ideas about what kind of company actually qualifies for this massive tax break. So let's talk about those ideas. Let's look closer at what we call the no-go zones. The law specifically says certain industries are out, and it is absolutely vital that you know if your company is operating in one of these off-limits areas. You see, the law is really trying to target a specific kind of innovation, so it deliberately leaves out a lot of service-based professions. So if your company's main value comes from fields like consulting, law, or finance, QSBS is probably off the table. A revolutionary biotech company? Yeah, probably good. A super successful financial advisory firm? Probably not. And that's a really critical distinction to make. But this right here, man, this is the biggest landmine of them all. This really vague catch-all phrase is this huge gray area where fortunes can just disappear. You know, does your business rely a little too much on the genius of its star coder? Or maybe on the reputation of its famous founder? This little clause can be used to disqualify companies that are built more on people's skills than on scalable tech or products. It's a question that requires some serious legal help to figure out. Now, you might be sitting there thinking, okay, this is a US incentive. How in the world does this apply to me if I'm a founder based in Korea? And that is a fantastic question. The answer lies in this really clever bit of corporate strategy that's known as the flip. You see, tons of Korean startups flip to a US C Corp structure because it helps them attract American VCs who just prefer the simplicity of investing in US companies. But here's the real magic. That exact same move also happens to be the master key to the whole QSBS treasure chest. The moment you become a US entity, you and your investors are suddenly playing in the right ballpark. But here is the kicker, and you have got to hear this. That 5-year holding clock, it doesn't start ticking until after you become a US company and get your new shares. This timeline shows you exactly why waiting is so dangerous. Look, if you flip in year 4 instead of year 2, you can't have a tax-free exit until year 9. That 2-year delay could literally cost you $10 million. Okay, the reward we are talking about here is absolutely life-changing. But the path to get there is super narrow, the rules are unforgiving, and, well, the stakes could not be any higher. This is a direct warning from the experts, and it's the kind of thing that keeps founders and their lawyers up at night. With QSBS, there is no partial credit. There's no close enough. You are either 100% compliant and you have a shot at the entire $10 million benefit, or you make one tiny mistake and you get zero. It is all or nothing. So, the most important takeaway here is this. QSBS is not a strategy you just tack on later when you think an exit might be coming up. No way. This has to be baked into your company's DNA from day one. Your legal structure, when you take funding, your business operations, every single decision has to be looked at through the lens of QSBS compliance. So now you have the map to this incredible hidden treasure, but navigating that terrain safely, well, that requires an expert guide. Your very next move should be to have a serious, in-depth conversation with your legal and tax advisors to make sure every step you take is the right one. Thanks for watching.